In this week's episode of the Stock Scores Market Minutes, I'm going to talk about the importance of avoiding emotional decisions and a mistake that I made today in my trading. We'll then do the regular weekly market analysis, scan the market for some opportunities, look at the trade of the week on TWTR. All right, so let's get into this week's topic, avoiding emotional decisions. I want to tell you a little bit about what happened to me today. Every morning I have to decide whether I'm going to focus on buying opportunities or short selling. And most days I buy because most days the market's trending up or sideways, but there are days when it's appropriate to short. Last night I do my analysis and I wrote down on my notepad, if the market stays in its upward trend at the open, go long. If, however, it gaps down and breaks the upward trend line, then go short. And I write that down. This morning, the market gapped down fairly significantly. And I forgot about what I had written down in my own analysis the night before. And I think the reason, upon some reflection, the reason why that happened was to go short at the open today was risky. It was the right thing to do, but it was risky because with the market gapping down, that would mean that there was more potential for loss if the downward trend did not continue through the day. It was safer to be a buyer because there wasn't that many trading opportunities to buy at the open simply because the market was showing weakness. And so what ended up happening was I bought a few stocks. I ignored a lot of really great short trades. I ended up not doing terribly because there wasn't that many things to buy. So I was essentially sitting there in cash, but what I should have been doing was short selling stocks because that's what my strategy told me to do. That's what my analysis told me to do, and yet my fear told me to do the opposite. And so that really comes down to this concept of emotional decision making that I want to talk about this week. Our decisions are easily affected by fear and greed, and emotion is the enemy of every trader, whether you've been trading for a year or, like myself, for 30 years. When making an important trading decision, we need to write down the facts that lead to the decision and ask ourselves, what is the other side of that decision? What is the other side of the argument? Now, I did that process last night, but this morning when I was looking at my pre-market process, I forgot to go through the facts. And instead, I succumbed to my fear. It's important to have a methodical, logic-based approach because that will help us to avoid our emotional bias. And believe me, after thousands and thousands of trades, I still make mistakes. I have to always come back to my rules, my process, and this was a great example of that. All right, let's get into this week's analysis. Starting off with the US markets, of course. S&P 500 had a pretty sharp sell-off on Friday. A lot of volatility in the last 3 or 4 days as the market's showing a lot of uncertainty. So what happened on Friday was we broke down through some support. We broke this little upward trend line. That's the one that I was talking about. But big picture, upward trend line is still intact. I do think, however, that because we've built this falling top and really went out of the session on Friday at the lows, we probably are going to retest this price range sometime next week. So that 275, 276 level wouldn't surprise me at all if we get there. And so some short-term caution is warranted. Not really time to panic, but short-term, I think we could see more weakness. Looking at the longer-term chart, really doesn't look that bad because we attempted to make a breakout this week. That failed. And now we may see some little bit of follow-through to the downside. However, until we start breaking down through support levels and until we start breaking upward trend lines on that longer term weekly time frame, I wouldn't get too worried. It is a possibility that it will happen next week, and so we need to be cautious, but it's not yet time to panic. Looking at the Russell 2000, a little more worried here. Now this is the daily chart, and what you can see is that we've got this falling top on the daily after the upward trend line has been broken, and then on Friday we broke down through that support zone. So I think we could see further weakness, probably at least to 145 and perhaps even farther in the days ahead on the small cap stocks that the Russell 2000 represents. All right, moving on to the Canadian markets, TSX. Here is the daily chart to start us off. And you can see that little upward trend line getting tickled a bit, a little bit of a concern there. Looking at the weekly chart, doesn't look too bad because again, the upward trend hasn't been broken, but it's always a little bit worrisome when we try to break out, move to some new highs, and then close below the open. That's why that candle is red. It's because we closed below the open. So again, some caution warranted. No reason to run for the hills, but got to keep a close eye on what happens next week. TSX Venture actually looks decent still. We have rising bottoms. We broke out. We had a little bit of a weak close on Friday, but not too concerning here yet. Looking at the currency market, the US dollar, pretty uneventful given the volatility in the stock market. We didn't see a lot of volatility in the US dollar, and we're still in that cycle of rising bottoms toward resistance. Essentially, it looks like a bullish chart. Canadian dollar is a bearish chart as we are in that downward trend. We haven't been able to break the downward trend line. Until we can break up through that, I would remain bearish of the Canadian dollar. Looking at interest rates, this is one of the more dramatic charts this week. We've talked in the last number of weeks about this cup and handle pattern with resistance right there. We broke it this week, and that implies that we are headed up into this range for the next level of resistance, perhaps a little higher than that, maybe 129. And so look for the bond market to go up, which means lower interest rates ahead. Probably not sharply lower, but it is a bullish chart for the bond market, which means interest rates going lower. On to commodities. This is the chart of gold. Fairly uneventful the last few weeks after that big sell-off that we had 4 weeks ago. And so we're getting a little bit of a pop-up. My concern is that we're going to build a falling top and roll over and head lower. And that's what you want to watch for. Now, it hasn't happened yet. We don't need to worry about it until it happens, but there's our upward trend line. And if we break down from a falling top, then weakness ahead for the gold price. However, we could keep moving up in the upward trend and get up to that resistance level. That's also a possibility. And so for now, remain cautiously bullish, but watch for that trend line break if you are interested in being in gold stocks or gold itself. Oil continues to what I call drift higher, volume not too heavy. It goes up a little bit each week, but there's not a lot of excitement there. And I think we need some excitement to overcome the really sharp sell-off that we had at the end of 2018. Finally, the fear chart, the VXXB, big spike up in fear on Friday. Look at the big volume that came into that, and it breaks just barely the downward trend line. We don't really apply trend lines to something like the VXX chart because it is a chart that has to have its the fund has to be balanced on a daily basis because of the nature of it being based on futures, which futures of course expire. So anyway, long story short, don't necessarily apply trend lines to it in the longer term. What is important to recognize though is we had a spike in fear, and that could bring a little more selling pressure next week in stocks. So my ratings then, neutral on both time frames for US and Canadian stocks, same for gold. Oil, I remain bullish short term, neutral longer term. Investors showed concern about the possibility of a recession on Friday, and that could turn into more weakness next week if support zones are broken. So be cautious, but it's not yet time to panic. Gold is stable, but could see some weakness again soon. Oil stable, but lacking enthusiasm. Fear is rising. All right, let's do our search for trading opportunities. We'll jump over to the Stock Scores website, go to the Market Scan tool, and we're going to run the abnormal break scan on the US market. And this scan looks for things that go up abnormally. And you'd think, well, why would you want to look for things that went up abnormally when the market sold off? But remember that inverse ETFs are a way to make money from the market going down. And so we may find in this search some good chart patterns on the inverse ETFs. Now, I actually did this chart or this scan before I started the video, so I know the answer to this already. And here's one of them. This is TZA. This is a small cap, triple leveraged bearish fund. It will go up 3 times as fast as the small cap sector goes down. And you can see that we broke the downward trend there, and then we had a little pullback. And now on Friday, we broke higher from a rising bottom on the small caps. That's basically an upside down version of the Russell 2000 chart. And that indicates that maybe there's an opportunity to be shorting small cap stocks, or for simplicity, buying one of these inverse ETFs like TZA. And as we go through, we'll see a couple more different versions. This is TWM. This is actually based on the Russell 2000. It's the identical chart pattern. But again, something to buy if you think that the market is going to correct, at least the market for small cap stocks. This will go up if small cap stocks sell off. Go through a few more here. I don't think, here's another version of that, SRTY, the Ultra Pro Short Russell 2000. It's all based on the same stuff, just different packaging. This is not a bad chart. Fidelity National Financial, breaking from this sideways pattern. I just don't love the risk reward of it. You know, it's going to get stuck at probably 40, 41, so it doesn't have a lot of upside for the potential downside. So I'd give that a 6 out of 10. There's another Russell related chart. Here's a chart of Papa John's, which I think signed up Shaq on as a spokesman or a board member or something on the session Friday. So it had a good break higher, one of the few stocks that was up on Friday, but the chart isn't really awesome. And so I think if you own it, it's something to hold, but I would not initiate a position there. Go through one more page of these and then we will get on to the trade of the week. Verizon, nice break higher on Friday. It often goes up when the market sells off. It seems to be a safety stock, but it is going to hit resistance at 61, so I don't love that. Decent yield, 4.18%. All of that stuff is shown up here. Here's Tiffany. Yeah, I guess people are still buying diamond rings, getting married. A little bit of positive price action on a day when everything else looked pretty ugly. I think it's a good hold. Again, I don't consider it an awesome stock to buy, but if you own this already, you know, you're sitting pretty good there. It looks fairly solid. All right, so let's jump back to the presentation. We'll look at our trade of the week. And this was one of my fails today. It wasn't really a big fail, but I bought Twitter at the open, not right at the open, 6 minutes into the trading day. And for $100 of risk, it was a 340 share position, which required $11,234. But with margin, you can cut that in by a third or to a third. So the capital required was $3,750. And you can see that it did quite nicely and was looking pretty good. I was feeling decent about the position. It was up 3-to-1 RR, but then the weakness in the overall market really sucked it lower. And it ended up closing at 0 RR for no profit, 0% return on a one-day hold. And so my problem today was that I was buying stocks when I should have been short selling based on my own analysis. And I kind of got suckered into watching these things too closely instead of looking for stocks to be shorting. So again, sometimes I want to show you that I make mistakes, and this is a great example where I was buying Twitter instead of looking for shorts. Well, that has been the Stock Scores Market Minutes for the week of March 25th, 2019. Hope that you've enjoyed it. If so, click on the like button, subscribe to the channel, and most importantly, trade well.